So here we go. This is my price target for Exxon Mobil. This is what I think the stock should be selling for. This is based on 3 different valuation methodologies. First off, we have a discounted cash flow. Then we also have a discounted earnings per share. And also we have a price to sales ratio. So what is the target price of Exxon Mobil? Keep watching to find out. Thanks everyone so much for watching. I do want to remind you I'm not a financial advisor. This is not financial advice. This is just my opinion. And let's face it, I am not right 100% of the time. So please do your own due diligence. What's up everyone? My name's Robbie. This is Robbie and Manila. And today we're doing a stock analysis on Exxon Mobil. Like I said in the start of this video, I'm going to give you my price target for Exxon Mobil. It's based on a valuation. I use 3 different valuation methodologies. But first off, we need to talk about oil prices. Obviously, Exxon Mobil is going to be correlated to oil, right? So what I wanted to do is kind of show you exactly what that looks like, because it's very important what happens to prices of oil and what ends up happening to the actual stock price of this company. So for example, on the very top, this is the revenue per quarter of Exxon Mobil, and on the bottom, we have, well, I want you to pay attention to the purple line. So the purple line is WTI West Texas Intermediate, that is crude oil. These are the prices of crude oil basically. And so I'm showing you here is what was going on between different time periods and actually the revenue of Exxon Mobil. So look at the decline. Decline in revenue for Exxon Mobil around, let's say, August of 2014 down to Feb of 2016, March. You see how this thing bottomed out right here? Now look at the price of crude oil. So we look at here, around $100-ish a barrel, goes down to $95 a barrel in August 2014, all the way down to $28 a barrel in 2016. As you can see, high correlation between the price of oil and the actual revenue that this company produces. So when we look back right now, and we're using, let's say, backward-looking numbers to kind of figure out what's going to maybe be a good valuation for this company, you know, we're looking at the past, which there have been some really down periods in, let's say, oil, comparatively speaking. So if you go back and you look at the price of oil, we have a peak here in 2008. So back in 2008 was when oil basically peaked around $140-ish a barrel or something like that. I can't even see it on this, but let's call it 140s per barrel. And it has not gotten back to that price yet, but of course now we're getting close. So if we come up here, we're looking here right now in the over $110 a barrel right now for oil. So basically what the deal is this is not a bad thing, of course, for ExxonMobil. It is a good thing if oil gets higher for this type of company. Okay, that being said, let's go to my price to sales target. So I'm going through the first target price I have for the company. It's $82 per share. This is based on this year, 2022, so this is an 11% decline. Basically, if you bought this, it would basically lose money. And if you held it to 2026, it'd be $109 a share. You'd only make $3.5% annual rate of return over that time period. So not looking like a great stock based on this valuation methodology. I will tell you this is the most bearish of the valuations that I did. To show you how I got these, so first off we have shares. Basically Exxon has been buying some shares back, but I'm assuming that it's not really, because over the past few years it's not bought a lot back, less than 1%. So that was the first step, figuring out what the shares are. Next step is to find the sales growth forecast. So what I do is I look back. Well, we have a median here that's very far off of the average, so I'm going to go with something in between these two. I'm saying that because I think oil probably won't be as bad as it was, at least over the past 5 years, that we're going to give it a decent sales growth. So I'm going to give it a 10% sales growth to start. I'm going to decline it 9.876% by 2026. And this gives us step 3, where we find the sales multiple of the company. And so basically, if we look at the average, it's $1.04 is the price to sales multiple. The median, that is, and then the average is 1.13. It's currently 1.23, so it's higher than the median and the average lately. What do we think about this? Well, do we think it's going to be a 1.5, more closer to what it was back in 2017 when things were better? Or do we think it's going to be closer to a 0.95? I'm going very conservative here. I'm going with a 1.15, so that's basically what it was in 2019. 1.15, this gives me an $81 price target up to 109. Pick your flavor here. So if you want a higher price to sales multiple, you can actually see a $106 price target. So if I was going to be more bullish, which I don't think it's out of the question, I'm just being kind of like conservative on this, but I do think, this is not that far off potentially if oil prices do well. And so that's what I'm kind of doing. I'm saying, well, I'm being very conservative here. And because of that, I'm getting a lower price target using a price to sales multiple. Next thing I do is I have this thing called a Cat 5 score. I take 5 different categories. I made the score up. So this is based on what I like to see. This is based on deciles. So I take the deciles of all of the different oil companies that this company is basically inside of its industry. And I'm saying, where does this fall comparatively? So if we look at the PE ratio, the actual is 15.30. This is in the 5th decile. And so I give it 2 points. The way this works is if you're in decile 1 to 4, you get 5 points. Decile 5 to 7, you get 2 points. And decile 8 to 10, you get no points. So I give it 2 points for PE. PE is a little bit, let's say, in the average of its industry, not that great. Forward PE is actually also not that great in the 7th decile, so that gets a 2. Price to sales ratio is actually pretty good for the industry, 1.23, and that is in the 2nd decile, so that is good. And then the price to free cash flow is actually 15.01. That is an 8, so that's not very good. So it's kind of expensive in terms of cash flow. Next thing I like to see is the industry-based profitability. So I compare it to the different companies in the industry on profitability. So gross margin is what I use here. It's got 30.50 as its gross margin. That's in the 8th decile, so not very good gross margin. Gets no points. The net margin is 8.80. It's in the 5th decile. That's better, so that is a 2 points. Next, we have the industry-based growth. So I look at the 5-year compound annual growth rate in revenue first off. So 6.60% is the growth in revenue. That's in decile 6. That gives us a 2. Next, we have earnings per share growth. That's been good, so 23.40%. So that's 3. So that's a 5. Then we have free cash flow, 42%. Now this one I don't use deciles. I just want it to be over 10, and it's over 10, so it gets 5. Then we have liquidity. So I just like to see the debt to equity ratio on this one, and it's got a totally fine debt to equity ratio, so the debt load's not too bad on this compared to debt to equity with a 0.28, so that's good. It's actually way lower than the average of 0.87. So this gets 5 points, a full score. And then my Rolex score, which is what I like to see, something called Piotrowski F score. You can watch my video on that if you haven't seen it. So this is a 9. So a 9 is the highest Piotrowski F score you can get. Very good. Then we have shares outstanding, and they're decreasing. This should say decreasing. And because they're decreasing, I'm actually giving it a 5 as well. So what I do is I add up all of these categories: the industry-based valuation, profitability, growth, liquidity, and the Rolex score, and I get a 63%. I like to see this over 70%, so this is a little bit low. It's lagging a bit on the valuation compared to its industry, so it's a little bit higher value. The valuation is a little high comparatively speaking, and the profitability is actually not there compared to some of its peers. So, but anyway, I got 63%. Let's go on and take a look at the price to free cash flow, the discounted cash flow. So taking a look at free cash flow per share, you can see $4.73 back in 2012 was the time period. And then it just declined over a few years because of gas prices or oil prices declining, right? So oil prices decline. It finally hits, let's say, a bottom here. You think it's a bottom, but then a couple years later, it's back to $1.25 per share. Then the COVID hits 2020. We're talking about negative 61 cents per share. So obviously a very bad time. Actually, that's when oil prices went negative, which we even knew that could happen, right? So now we're sitting pretty at $8.43 for 2021's free cash flow per share. So that is a question of, is this going to be more similar to what happens going forward? Are we going to have these higher cash flows comparatively because the price of oil is going to stay, let's say, above, let's say, $60, $70 a barrel? Or is it going to crash again? And I don't know. So that's what I'm not sure about. And because I'm not sure, when I come over here to do a discounted cash flow, what I'm doing is, over a 10-year period, I'm going to use a growth rate only of 6% because I don't know if we're going to have oil prices fall again because it's a commodity and it's hard to really forecast this, right? So I'm not sure what's going to happen. I'm going with a conservative 6% free cash flow growth. This gives me Still, $135 price target for the company, so that gives me a 32% margin of safety, which I like to see a 25% margin of safety. This is a good thing. Then over here, I do the earnings per share, the discounted earnings per share. Similar thing with this. So we've had times where earnings per share have been quite high, times when it's actually not been as high. So I'm going with a 6% as well growth rate over the next 10 years for earnings per share. I think this can easily be achieved by the company. Now, we have an $87 market value for this. That's negative 5.34%, so not as good. So let's go over and see what we have for the weighted average. So here we have the weighted average for the company. So we're using 3 different valuations. We have the DCF, discounted cash flow. We have the discounted earnings per share. We have the price to sales valuation. Now what I do is I'm taking a lower weighting for earnings per share and the price to sales because discounted cash flows are really the basis of what at least modern, let's say, finance thinks that a stock should be worth. A stock should be worth the future cash flows of the company discounted in today's dollars, right? So $135 target price, weighted 50%. Then we have the 87 and the 82, gives us $110 price target, and that gives us an upside potential of 20%. I do think I was conservative with this. I was conservative with my cash flows. I did only a 6% growth rate in cash flows, earnings per share. For price to sales, I also did pretty conservative multiple, and I didn't grow revenue that much. So I definitely think that if oil prices, let's say, were to average $70 a barrel or higher over the next few years, this company is definitely easily going to be a $110 price target. Okay, so now we're going to do some technical analysis, and I did want to show you something fascinating, actually. So look at this chart. The orange line that we're looking at here is the S&P 500. This is the SPY ETF. Now, SPY, look at this, let's say, 2020 bear market thing that happened, of course, when COVID hit. Now, look at energy, right? So we're talking what happened going back until about September of 2019. Now, of course, the S&P 500 did a lot better than Exxon Mobil because who's investing in oil when the oil prices are negative, right? So Exxon Mobil was less than, for example, the company Zoom, right? The market cap of Zoom got higher than Exxon Mobil, which things were like really ridiculous when you look back. And so that obviously should not have happened. And so what we're looking at now is we're seeing that actually Exxon Mobil has outperformed the S&P 500 after underperforming it for a few years, right? Now it's got a higher rate of return going back until September of 2019 than the S&P 500. Let's throw on triple Q'd, so the NASDAQ 100, and it's almost exactly the same price here. So NASDAQ 100 a little bit higher, but actually if you go a little bit further over here, you're going to see NASDAQ actually underperforming also. So depends where you put this thing, but basically the deal is energy is now suddenly, or let's say ExxonMobil and also energy is suddenly been a good place to put money when it was a horrible place during the pandemic and that time period after. So it just goes to show things change in the market, and suddenly ExxonMobil might be looking okay. So the first thing I do want to talk about is it's in an uptrend channel. It's still there. I'm going to turn these off real quick. Now we're going to zoom in. So there is something I do want to talk about, kind of important. So we have some bearish divergence here, and there's been a few points in times where RSI and MACD has diverged from the price action of this company. So I'm not sure if this is important because it's happened in different time periods as well, and it seems to not have really hurt the upward trend of the company's stock. So maybe not a big thing, but just keep it in mind. If I'm going to buy this, I'm looking at this thing. It's up on the top of this uptrend channel, right, on the parallel line of the uptrend channel. So I think there's going to be a bit of a pullback. I got this little projection here that we can see. So it can potentially, stay up on this uptrend line, but I do think it's probably going to come off it a bit, maybe down here into the 80 area, and that would be an area where I might want to look to see if it would be a good place to buy. Now, there's one more thing that I think is important, and it is the fact that a lot of people look at this and they say, well, oil prices are not going to go any higher. The price per barrel of oil is almost at historic highs. The highest it'll ever get is $140. Well, I'm going to point you to this chart here real quick, and it's going to show you. Of course, we have the peak in oil back in 2008 and where it is now, and obviously there's a room to run to get to historic prices, but this isn't how you should be looking at it. What you should be doing is saying, well, okay, this price, $140 a barrel, you have to adjust that for inflation, right? Because things are more expensive now than they were back then in 2008. So we have to really think about this on how much is this in today's dollars? What's the real price of oil based on inflation? And so what we're looking at here is the inflation adjusted oil prices. And so when you look back and you see that time period in 2008 when it was $140 a barrel, well, if you adjust that for inflation, that is actually around $175. So really what we're talking about is if oil does go up to $140, $150 a barrel, it is really not at historically high levels, comparatively speaking, in terms of inflation. It's got to get to $170-ish a barrel to get there. So basically what I'm saying is oil can definitely go higher right now, and it won't really be at the peak of how much it costs someone to buy a barrel of oil, basically. So anyway, that's all I got for this video. I hope you enjoyed it. Please let me know in the comments what you think. Do you like Exxon Mobil? Are you buying it? You're going to get into some energy stocks? Let me know. I'd love to hear from you. And I got another video coming up on the end screen. Please watch that right now.